Hi, I'm Blaise from W Consulting. In today's IFRS Quickies, we will be looking at the amendments to IFRSs arising from the annual improvements to IFRSs for the 2009 to 2011 cycle. The amendments covered by this cycle include amendments to IFRS 1, first-time adoption of IFRSs, IS 1, presentation of financial statements, IS 16, property, plant and equipment, IS 32, financial instruments presentation, and IS 34, interim financial reporting. The amendments to IFRS 1 deal with the situation where an entity that was previously applying IFRS left IFRS to move on to another reporting framework and now subsequently is moving back onto IFRS can be seen as a first-time adopter. The standard clarifies that in such instances an entity is permitted two choices. The first choice would be to reapply IFRS 1 in totality. This implies that the entity has to apply the mandatory exceptions as well as having access to the optional exemptions that are available to first-time adopters again. If an entity does opt for the first choice, in other words to reapply IFRS 1, it must disclose the reason why it stopped applying IFRSs as well as the reason why it is subsequently resuming application of IFRSs. The other alternative for such an entity is to apply IS 8 and account for the re-adoption of IFRS as a retrospective change in accounting policy. This would entail undoing any transactions that might have occurred or been recorded in terms of other GAAP or other reporting frameworks, and essentially presenting a set of financial statements as if the entity had never left IFRS at all. Under these circumstances, if the entity chooses to adopt that, the entity would then have to disclose the reasons why it has elected for that option as opposed to reapplying IFRS 1. The other amendment to IFRS 1 deals specifically with one of the optional exemptions available to first-time adopters in respect of borrowing costs. IAS 23 requires borrowing costs in respect of qualifying assets to be capitalized to the cost of the qualifying asset. The amendment, or rather the amendment to expand the exemption, allows a first-time adopter to elect when to apply the requirements of IAS 23, either at the date of transition to IFRS or from an earlier date. If an entity, well, regardless of whether it's an earlier date or whether it's the date of transition, the entity will have to leave whatever borrowing costs have been capitalized under previous GAAPs prior to the elected date rather, and account for borrowing costs in accordance with IAS 23 from that time onwards. The second amendment to IFRSs deals with amendments to IS 1, presentation of financial statements, and the amendment clarifies the form of comparative information and what comparative information is required. The standard now distinguishes between two types of comparatives. First, we have minimum comparative information, which is the bare minimum mandatory requirements in respect of comparative information. And then we have additional comparative information, which includes voluntary information that is not required by any IFRSs. At a minimum, an entity must disclose 2 statements of financial position, 2 statements of profit or loss or other comprehensive income, 2 statements of cash flows, 2 statements of changes in equity, and 2 of all related note disclosures. This is essentially what we've always been doing in terms of IS 1. The additional comparative information allows an entity to voluntarily present additional comparatives, but can do so on an ad hoc basis, which basically means an entity can choose to present, for example, 3 statements of financial position and 2 of all of the other statements, or 5 statements of profit or loss and other comprehensive income and 2 of all the others. So an entity is not obliged to extend the comparatives across all of its financial statements, but only in respect of the additional information it wishes to provide. The only proviso is that if an entity does choose to present additional comparative information, it must present any related notes that go with that comparative information. The standard has also been amended to clarify that where an entity makes any retrospective adjustment to its financial statements or any prior reclassifications, the entity will have to present an additional statement of financial position as a comparative. Now, this requirement has been expanded and clarified to explain that this additional comparative for the statement of financial position is only required in respect of the beginning of the preceding year, In other words, not +1 for any comparatives provided. And it also clarifies that note disclosures in respect of the additional statement of financial position are not required. The third amendment to the Annual Improvements Project includes the amendments to IAS 16 Property, Plant and Equipment. These amendments clarify whether major spare parts and standby or servicing equipment meet the definition of property, plant and equipment or the definition of inventory. The standard clarifies that if an item of, well, be it a spare part or servicing equipment or standby equipment, meets the definition of property, plant and equipment, then it must be classified and accounted for as PP&E in accordance with IAS 16. If the item does not meet the definition of property, plant and equipment, it must be accounted for as inventory. So things that will be consumed immediately once they are used would probably fall within the definition of inventory and therefore accounted for in accordance with IAS 2. The fourth amendment to IFRSs comes from IAS 32 financial instruments, and this amendment clarifies that when an entity makes distributions to equity holders, any related tax effects of the equity distribution are accounted for in accordance with IAS 12 rather than in accordance with IAS 32. The previous version of IAS 32 required an entity to present the effects of an equity distribution net of any related tax effects, which essentially was a conflict with the requirements of IAS 12. So the amendment clarifies all distributions are accounted for gross or excluding any related tax effects, and the tax effects, if any, are accounted for in accordance with IAS 12 income taxes. And the last amendment to IFRSs deals with interim financial reporting, and this amendment clarifies the nature of the information that is required to be presented in an interim report. If an entity does present an interim report, and if that entity also presents segment information, the standard now requires disclosure of any movements or any changes in assets per segment to the extent that that information is provided to the chief operating decision maker internally. The effective date of all of these amendments is 1 January 2013. Entities are permitted to apply these changes earlier, but if they do so, they would be required to disclose the fact that these amendments have been applied earlier. That's it for today. Thank you very much for watching.